All right, good morning, everyone. We're a little bit late getting started, and I apologize once again for this. For whatever reason, I, Zoom doesn't appear to be working very well on these computers, and I keep having to bring people over. And I will admit that I'm not a tech person, so um, I'm an accountant, not a tech person. But for whatever reason, Zoom does not appear to be cooperating very much. And as I understand, Zoom has made some changes to the enterprise systems, and so we're all sort of figuring this out. But nonetheless, I will post this as a video, and I suspect most of you are watching it not in real time, but sometime after the fact. So it may not be an issue with you whatsoever, right? So we do have students who log in on a real-time basis or who attend physically. And again, that's the whole logic of the attend anywhere methodology. But we've had some difficulties getting on here, but I do want to, after we've sort of made all these disclosures about in these sort of issues and excuses and whatnot, I do want to get into the main part of what we're doing today, which is covering the remainder of chapter 4. Okay, so excuses are done, right? So again, as I've talked about before, we deferred the due dates for the first, second, and third and fourth weeks activities a week later, and we have the first exam due this Sunday, and we'll talk a bit about that before we leave today, and explain what's going on there. And if you have any questions about anything, feel free to reach out to me. And by the way, you can call me, stop by. You can whatever you want to do. I'm pretty much here, Monday through Friday. I really am a full-time faculty, so I'm not really going anywhere. And feel free to stop by. Or if you are not in the Albuquerque area and you want to do a Zoom call, I'm free to do that as well. My own personal Zoom account works very well, so no problem there. And I'm more than glad to do that. And we can do things like share screens and whatnot, look at what's going on with what's happening. And one of the things that seems to come up is the idea that students have questions about individual problems. And it's really difficult for me to see what's going on because even if I log into the system and connect, I can't get the same numbers that you're seeing. And so I really need to see what you're looking at there. And so sometimes sharing the screen makes a lot of sense. And I can certainly accommodate that. And I'm willing and able to do that. So I'm pretty much available, every day. Saturday and Sunday a little bit less so, but certainly Monday through Friday. Okay. All right. So for this week, we're going to finish chapter 4, dealing with sort of the wrap up of the three major statements in financial accounting. We talked about the balance sheet before. We're talking here about the income statement, comprehensive income, and also the statement of cash flows. Statement of cash flows being one of these statements. Now, we're not going to talk so much about the statement of retained earnings here. It does come up in intermediate accounting. And one of the things about intermediate accounting that I've long said is the idea that it sort of is a walk around the financial statements, and we talk about what's going on and drill down deeply into these issues. So for this week, if you've not done chapter 3 yet, focus on chapter 4, and the due dates are tomorrow for the Smart Book quiz in Connect. And hopefully everyone's gotten to Connect. I think most people in the course have, or dropped by now if they haven't. And then the homework, and if you want to do the bonus is extra credit. You can do it or not do it. It's up to you. But it does add points to your total score. It doesn't work against you. It can only help you. It's only a numerator issue, and so that's good for you. So chapter 4 is coming due this week, but also the first exam. And one of the things I talked about when I discussed deferring some of these activities is the fact that if you're running behind, it may be problematic for you to sort of catch up. And so we don't want people to fall behind. And it's a trade-off. And my experience with this trade-off activity is I would rather give students more time as opposed to less to do things. And it really doesn't matter to me. I mean, really, we're in the business of providing education for this particular course. And so if I can give you more time, that's great. So the exam is due this Sunday, 11 p.m. That's the due date. And I'll talk more about the exam before we leave today. All right, so let's kind of wrap up what we're talking about with regard to chapter 4 here, which deals with, we talked about the idea of the cash flow statement and what's going on. And so we kind of get to that. And then we're going to sort of circle back to this idea of ratios, okay? Now, this is an important area that is sort of the intersection of accounting and finance, really in my mind. And it's the idea that we have certain ratios, which ratios are simply relationships between one thing or another. And in this case, we have different categories of ratios. We have turnover ratios, which are one thing. We have profitability ratios, which are another. And so we're going to kind of go through these. For those of you who took 2120, which is Principles 2 here, as I mentioned before, we covered this in Chapter 2, mostly because it really belongs to Principles 1, but we just sort of didn't have time, and so we kind of rolled it forward. And a lot of students who take Principles 1 also take Principles 2. If you did accounting somewhere else, you probably came across these elsewhere, but nonetheless, let's talk about what's going on. So we talk about profitability, and we're talking about activity ratios. And so let's talk about some of these, and these are really related to how efficient the company is for its business. So in this case, we have asset turnover, net sales, average total assets. I don't know, frankly, how important this is in the pantheon of ratios, but nonetheless, it's what it's really saying is how quickly we can turn over our total assets and convert them to sales. In my mind, this is not the most important ratio at all, but we'll get to ones that are more. And by the way, asset size differs among enterprises, and there are some companies that have a gigantic amount of earnings and very little assets, right? And there are some companies that have very large assets and very low earnings, and so it's something you have to really drive yourself into in order to understand what's going on with the specific company. Receivables turnover and inventory turnover, these are important, and these are ones that really demonstrate the efficiency of the company at converting things to cash. First of all, we take net sales. Now, first of all, net sales are what? Net sales are those sales, gross sales, minus things like discounts and returns and whatnot. Now, some companies have no discounts, offer no discounts, so that's not an issue. It goes to zero. And some have no return policy whatsoever. And so as a result, net sales are the same as gross sales. But for the most part, net sales usually is not a huge difference between that and gross sales. But nonetheless, it is the figure we're using in the numerator here, divided by average accounts receivable. So now average anything in these financial ratios is really dependent upon what your preference is as to how accurate you want to get and how much work you want to do in order to present the denominator here. And then as you can take, what is very common is taking the beginning accounts receivable plus the ending accounts receivable simply divided by 2. Now that may not be ideal, particularly because think about what's going on with beginning and ending inventory figures is you're in the end of some inventory cycle that may not really represent what's going on throughout the majority of the year. In fact, companies choose year ends because they want to sort of dial down the activity and capture, particularly for seasonality, they want to sort of capture that within that year. So that may be a problem. What may be more accurate is to take every month ends or every mid-month figure and then divide by 12 to get average accounts receivable. And the same goes with inventory, the number down below there. That may be a better way sort of smoothing this out. I have seen, unfortunately, companies take average receivables and inventory for that matter, divided by 365 by simply adding up all the ending values at the end of the day, divided by 365. And so it's not terribly difficult when you have computer technology to do that, but it's whatever is the preference, okay? Here in this accounting course, we tend to focus on the most basic, was beginning plus ending divided by 2, and that's going to be the average figure. So let's go back to receivables turnover. What is this saying? It's saying that how many times we turn over our receivables in a given year. And we're talking about credit sales, and probably the numerator should sort of discuss net credit sales. In business transactions, a lot of these sales are credit sales, where credit is extended for 30 days or whatever the case might be. Business to consumer often are often involve no credit, and so it's a cash sale, which would not really involve the receivable because there is no receivable. The money is received at the same time the product or service is delivered. So in this case, the receivables turnover ratio is simply that amount of sales, credit sales, divided by the average receivables, okay? And we're going to sort of make this a little bit more meaningful once we extend that to the days on hand, right? Inventory turnover is simply cost of goods sold, which think about why we include this in the numerator. Cost of goods sold really represents the cost of all those goods that we've absorbed over time and we've now sold, and they're gone. Those goods are gone, and once those goods are gone, we simply record cost of goods sold divided by average inventory, if we have inventory. Now, some companies have no inventory, so inventory is not an issue, right? In which case, the entire calculation makes no sense. But if you do have inventory, cost of goods sold over average inventory makes sense. And that is the idea that how we're trying to assess how profitable or how efficient this company is at turning over inventory. And one of the things that I sort of circle back to again and again is this idea of higher the better, lower the better. In this case, the higher asset turnover is the better, higher, all these are the better. And that is the idea. The faster we can turn these things, the better. By the way, there are some companies that turn inventory extremely quickly, right? Think about Walmart and just in our own experience. You go to Walmart, I go to Walmart occasionally, and at the end of the day, there are a whole, I think I've said this before in this class, there are whole, sections that are wiped out because people are just sort of pulling these off shelves. And so as a result, they have very quick inventory turnover, right? That compared to something like a company that sells Cadillacs, right? Not so much quick inventory turnover, but it's a different kind of business. And the thing about these ratios is they've really got to be compared to the industry standard and maybe even more importantly to one's peers in the industry to see what's going on. If you find yourself deficient in these areas, then that's a management challenge. What do we do? If our inventory turnover is less than a major competitor or all of our competitors, what do we do, right? And that's it's a challenge that is posed to management. And really, we're talking about business school courses here. We are talking about management and what management does about things, right? So that's the activity ratios. And we're going to take these then, and we're going to sort of compare them to the, let me see, did I go too far here? To the days. System's really slow here. Wow. And we're going to compare those to the days. And so by taking those ratios, which are just simply numbers, we're going to divide them into 365. I've sort of lost my cursor here. If I can get it back. Give me a second here. Let me, there we go. All right, so asset turnover, receivables turnover. All right, so activity ratio. So let's talk about this. First of all, receivables, and we'll get to inventory in a second. So one interesting measure here is, and it's applied broadly across the organization, although, as I've said many times before, we can take this information, if we can divide it by division or product or region or whatever, we can make more meaningful comparisons. But in a broad sense, what are we talking about with respect to the average collection period? So we're saying that we take the 365 number of days in the year divided by receivables turnover ratio, and we're saying the lower the better, because it means these receivables, right? We're collecting them faster, right? So the lower the better. Nobody wants receivables out there that are uncollectible or difficult to collect. And if you've ever been involved in collecting debts from people, personally, I think it's a miserable activity, but it is necessary at times to collect, even on a business-to-business transaction basis, where sometimes companies just simply don't pay on time or don't take advantage of discounts. And that's maybe a separate issue from the fact that it requires and necessitates management intervention in order to collect that receivable. So the lower the better. The fewer days number outstanding, the better, because it translates to cash to the company extending the credit who has provided the good or service in the first place and has extended the credit. Okay, so the average collection period, the lower the better in our particular judgment. And then we get to inventory turnover, and we're going to say here the lower the better also, right? So we kind of talked about this methodology earlier in terms of lower the better, higher the better. Here, the faster inventory turns over, the better, which means average days in inventory should be less. So remember, we take this inventory turnover ratio, which we got from the initial analysis here, cost of goods sold over average inventory. However you define average inventory, whether it's on a weekly, monthly, whatever, or even daily. I mean, I've seen companies do it, and I've had the disadvantage of seeing that. But whatever it is, it's this, you want to turn this over quickly, but so you want a higher ratio here, but it also means you want a lower ratio here because you want average days inventory to be less. What does that mean? And what is the importance of this? It means that inventory, beyond all the problems that are involved with inventory, and there are a lot of problems in things like spoilage or expiration dates or theft and whatnot, all kinds of issues. But it's the idea that inventory doesn't really do anything for you. It's simply an asset that you're putting on your books, and until it's sold, it doesn't release any kind of revenue. So companies have been trying for quite some time to reduce inventory. And it's interesting because some companies will go to extreme lengths. And I got my flu shot last year at the Highland Pharmacy here on campus, or near campus, I guess. And they had almost like nothing on inventory on the shelves. It was pretty amazing. And I'm sure they have other inventory. It would be like one box of Band-Aids and one box of Advil or whatnot. I mean, they really, really were concerned about having too much inventory. And so, that's probably an ancillary business to them anyway, but nonetheless, you get the idea that inventory itself causes problems, and the faster we can move it in and out, the better. And I come back to Walmart as being sort of the exemplar case of a company that really is very efficient at moving inventory, and they can track it and they know where it is, to the point where they can know where a pallet of paper towels is on an 18-wheeler in Arkansas or whatever. I mean, they're very sophisticated in that regard. But the idea is you got to move it, because inventory itself doesn't do anything for you. So inventory turnover ratio is this idea that we want a faster turnover. So higher here, we want a higher number, average days in inventory, which is simply the complement to that. We want fewer days on hand. And the less days on hand, the better. And so that's kind of what's going on there. And there are some industries in which inventory doesn't move very quickly. We talked a bit about jewelry stores and high-end areas like expensive car dealers and jewelry stores and whatnot. These ratios are going to differ, and this is why we cannot apply one blanket metric, one number for all these ratios. We just can't do it. It really depends upon the industry. What we can say in general terms is the higher the better, the lower the better. And by the way, one thing I should mention here, because it sort of comes to mind, is the idea when we say higher the better to whom, and we're going to assume that the owners of the company, the shareholders, their interests are aligned also with other stakeholders. That is, debt holders, employees and whatnot. So we're going to assume that their interests are aligned. That's not always the case. It sort of breaks down when the company enters bankruptcy, particularly those debt holders that sometimes are left holding the bag, and certainly equity holders are very left holding the bag. But we're going to make the assumption when we say higher the better, lower the better. We're going to assume that there's a congruity of interests and between the two parties, right? Even though they're different parties whatsoever. Equity holders oftentimes have no voting rights or limited voting rights and whatnot. So, even if they do own lots of equity, their votes are sometimes overwhelmed by others. Okay, all right. So this inventory turnover ratio. Any questions? I don't think we have too many people on the call right now. So let's go on to. My cursor keeps flying around the screen here. Let me see. Okay, so let's talk about activity. We talk about that. Profitability analysis. Okay, this is probably the main issue that I want to talk about today. And that is, how do we measure the profitability of the company? And by the way, one of the things that is interesting about financial ratios is that sometimes some of the metrics may not be applicable to other companies. You take a company like Kroger, which is the parent company of Smith's and Vons and King Supers, if you're in Colorado, they may have very, very low profit margins, that is, gross margins, but they may have a pretty good return on assets, return on equity, and whatnot. They may differ from some other company, which is completely different in a separate industry altogether. And it's really hard to sort of compare, which necessitates this comparison of company to company within the same industry, so that we can talk about peers in industry. And sometimes they go head to head against one another. Sometimes they don't. But nonetheless, this data has been collected over a very long time period. And for those of us who've been I sort of cut my teeth in credit analysis from early on, we're sort of tracking industry comparisons in order to say, how does this particular company, whatever we're talking about, match up with its competitors? Okay, let's talk about profitability analysis. And so we talk about profit margin on sales, net income over net sales. Now, I would refer to this as what we call net margin. Okay, net income, and this is an after-tax figure, presumably over net sales. And so it means for every dollar of sales, this is what we've earned on an after-tax basis. That's clear to us, and it's now available to shareholders in terms of dividends or whatever, or simply recapitalizing those earnings back into business. So that's a net margin. Okay, this differs from gross margin. Gross margin is simply sales minus cost of goods sold. We take that gross margin figure, develop it back into net sales, and we get a percentage. So this is going to be a percentage in all cases. We have a dollar figure divided by a dollar figure, and we're going to get a percentage. And the same goes to the gross margin. But the thing I want to emphasize here is that when we talk about margin, usually what we're talking about is a percentage. Okay, and when we talk about profit, we usually talk about a dollar figure. So gross profit is a dollar figure that takes sales minus cost of goods sold equals gross profit, all dollars, all the way across, right? Net profit is the idea of net income after tax, presumably, divided by net sales. It's going to be a percentage as well, right? Okay, and so, but the net margin is the net income is a dollar figure to begin with, right? So we got to kind of be clear on what's going on here, and sometimes this is not really, in my mind, not elucidated enough in accounting textbooks. The idea of net versus gross versus net, and particularly with those companies that have inventory, whether it's manufacturing or merchandising, whatever the case might be, we're not really getting there. So profit margin on sales, this is a net margin, net income over net sales. Okay, higher the better, right? We want higher net income regarding net sales, right? Return on assets is net income over average total assets, which is going to be a percentage also. So always expressed as a percentage. ROA, to me is, and for most industries, is less applicable, I think, than other industries. I came out of the banking industry where ROA was the big number, but I can't think of too many industries in which it is that big. And when I was in banking some time ago, a return on asset, by the way, this is going to be a dollar figure over a dollar figure. It was a percentage, a 1% return on assets was considered to be good. That was like the gold standard. And that seems like really low stakes, but if you consider the fact that the assets themselves are really a reflection of borrowing other people's money and investing and whatnot. So and it's a very low margin business in general. You can get the idea. So, but ROA, I don't know is that critical. ROE, return on equity, I think is much more representative of what we're looking for, particularly in the financial community that's looking for returns that say, all right, for every dollar of investment that we're back with the investment, this is the numbers we're going to get back in return. This is also expressed as a percentage. Okay, so all these higher the better, right? I want to talk about ROE because I think it's really the most important figure here. And companies are all in the board with regard to ROE. There are some companies that have no income right now; they're negative earnings, and so ROE is not really relevant. You can do the math, but it's going to be a negative number. What the heck does that mean? A negative return? That doesn't really mean very much. So you have to sort of discard it. But what about companies that are profitable? So let's take a look here. I pulled up before the class. Let me see here if I can pull this over. Some numbers with regard out of Yahoo Finance, and Yahoo Finance it's a pretty good site. I mean, it's one that we everyone pretty much is familiar with, and I'll bring this over here in just a second. But I do want to talk about the idea of how we do comparisons of companies based upon in the same industry. And I'm going to pick two industries here. Two companies in the same industry. I'm going to pull up waste management, and I'll sort of bring it over here. Okay. I could do it. All right, so I'm going to bring this over here to the screen. So Waste Management is a company that's involved. You probably have seen their trucks around, their logo, they collect garbage. That's the industry. You might think, oh, great, garbage industry. Well, okay, there's a lot of money in the garbage business. I can tell you that. So, all right, so Waste Management is one example. The other that I'm going to pull up here is maybe it's nearest competitor, right? We can argue with this all day long as to whether it's the nearest competitor, but it's a company called Republic Services. And so let's talk about that here. I had this on the screen until the computer guy came and took all this stuff down. So I apologize for that. So, all right. So I think it's RGS is what is the stock symbol. Okay. Oops. No, that's not it. Republic. Oh, shoot. What was it? Republic. So waste management accounts. And I'll get to it. Well, let's not worry about that. Let's focus on this right now. So, all right. So I pulled up Yahoo Finance, and obviously this is a very popular, well-known website that sort of summarizes for people what's going on with particular companies, and it's sort of has a view toward helping investors understand what's going on. And by the way, I think the website works better on my iPhone than it does on a computer. That's crazy, but it really does. And so I've had a lot of success. Well, let's talk about waste management. So this is a company that collects garbage from primarily commercial customers, and they have dumpsters and trucks and all that. And they dispose of the waste, and they do recycling. They do a lot of different things. And so let's talk about some of the information here that impacts us and our interest to us in terms of this particular discussion. So let me click on this and see what we got here. So, all right. So remember, we're talking about financial ratios here, and let me kind of go down here. All right. So, come on, come back, come up. Oops. All right, there we go. That's okay. All right. So return on assets 6.97. I don't know what that means, but the return on equity 32.89. Now, there's a reason why I picked waste management is because it's got such a large return on equity. What does this really say to investors? It's saying for every dollar of invested equity or ownership of the company, we have 32 cents returned to us after tax, and that's a pretty big number. And you can't get it on a savings account or bond investment typically, or something that's easily attainable. But the stock market can return this amount of return. Doesn't mean the stock price is going to track with it. I should be clear about that. But this is a pretty big return on equity, 32 cents or 33 cents in this case, return on equity. So that's something to think about, right? And there are other companies, in particular within the same industry, that do not have the same amount of earnings power. Now, one of the things that I should talk about, and it sort of ties back into what we discussed before, and I think it's important for us to sort of close the loop on this, is the idea of why is return on equity so high here, right? And it could be the company's got quite a lot of debt, right, relative to equity. And this is something that maybe is a bit beyond what we're doing in intermediate accounting, but it's something that, for those of you who are going to study finance, is a more germane topic, and that's the idea of debt to equity and what we call financial leverage. We talked about it here in this course, and if you take a look here, kind of go back here, we have some of the financial measures here. We have a debt to equity ratio, and this is a little bit irritating. They present it in terms of percentages, but it should be 2.61, right? All we got to do is remove the decimal sign, move the decimal 2 points to the left, and we could say that we have, for every asset, we have $2.61 that is funded by debt as opposed to equity. So it's a bit high. It's not the highest I've seen by far, but it's a little bit high. But what does that mean for return on equity? And this is really what is important. It kind of goes to this topic and this really interesting interface between accounting and finance, where we say that big companies sometimes can benefit from lots of debt because they can leverage that debt to make more money. And as a result, they're sort of like a lever, right? It's just like in science where we use a lever to move something small object, move something bigger. And so in this case, we pay debt holders a certain amount, but we earn a lot more on it. And so using other people's money is really a key aspect of what finance is all about. So, and again, there are a lot of interfaces between accounting and finance, and my background is in finance. Although as an accountant, I do sort of appreciate these linkages, but these are sort of things that I think we should think about when we talk about these ratios. And we can compare these one against the other in order to make good understanding, good assessments as to what's going on. So we're talking about the ROE. So we're going to go to ROE here and talk about the DuPont framework. So this is something that so DuPont is one of the oldest companies in America. It's been around prior to the Civil War, I think. And it's a chemical company primarily. And they came up with this idea of a framework where they sort of break down these measures in terms of constituent variables. And so let's talk about what's going on here. This is really not overly complex math, but it's one that sort of allows us to sort of spread out and talk about what's going on. Particularly if you have a question about, hey, where does ROE come from here? Well, then one of the elements of it, we can sort of break it down by looking at the mathematical elements. So return on equity here is also net income over average equity, which is the basic definition. A dollar figure over a dollar figure is going to give us a percentage. ROE is always a percentage. ROA is always a percentage. And by the way, when we talk about these ratios, sometimes we have dollar figures, whether it's something like working capital, it's a dollar figure, gross margin, it's a dollar figure, and net income is a dollar figure. But we convert those sometimes to percentages where gross margin, gross profit is a percentage of net sales. We call that gross margin. Slap a percentage sign onto it. Net income divided by net sales is a percentage. So we have to kind of understand that we have dollar figures, percentages, and sometimes just numbers. Current ratio is one thing and development another thing, and you're going to get a number, right? So, but those are the only denominations: numbers, dollars, and percentages that we're being faced with, right? So, all right. So back to DuPont here. So what are we getting at here? So DuPont years ago, a very long time ago, 100 years more and more, sort of sliced this up into return on equities. Profit margin times asset turnover times the equity multiplier. And this is something we haven't really gotten into yet. The multiplier is simply total assets over equity. And that's simply a mathematical relationship that says that we're going to sort of multiply this by this. So here's the thing. If we do the math here, cancel, and we have net income over average total equity, we get back to the same place we got before, right? So you're thinking, well, what are we doing here? All we're doing is canceling. Okay, that's fine. But we're trying to isolate what the sources of this percentage are in the first place. Is it the profit margin that's really high or low, the turnover that's high or low, or the multiplier, which is simply a relationship between assets and equity? And by the way, it's going to be something greater than one if there's positive equity, right? Or maybe we want total assets to exceed total equity, presumably, because there's probably going to be some debt. So all these are relationships. So why do we care? Because we really care about finding out why this number is what it is. And so this is a way of doing a mathematical extension. And that's really all it is. Mathematically, it's simple. Cancel. We get this numerator over this denominator. Okay, not a big deal. But we sometimes want to know what are the causes of this. It's one thing to determine a number or percentage in this case. It's another to determine why. And answering the why question is really an important thing. Okay. Also, you can take return on assets times the equity multiplier, and you're going to get the same sort of facts going on here. Cancel, net income over average total equity, and you're going to get the same thing. But it's just a different approach, right? That deals more with the asset side of the equation. And but all these are simply mathematical relationships that get us to the same place. It's not really intended to confuse. It's really intended to sort of illuminate what's going on with some of these ratios that are important, and that the financial world in particular, the financial community, I guess we should say, really focuses on because they want to know what's happening. And more importantly, it's this idea of what's happening over time. What are the trends in ROE? What are the trends in ROA? ROA is probably not as important as ROE, but we talked about this idea that with waste management, very, very high, relative to a lot of other companies, return on equity. Okay. All right. So questions before we sort of wrap this up for today. I do want to talk a little bit with the exam, but I want to sort of finish up. We're almost done here, and talking about what some of these financial relationships are about. So quick quiz here, inventory ratios. So Harrington's Pet Supplies begin the year with an inventory balance of 220,000. Year-end inventory balance is 185. So immediately what you should be thinking of is beginning plus ending divided by 2. That kind of gives you a rough average. Cost of goods was 900,000. Calculate the inventory turnover in average days. All right. So there are two calculations, both of which are related to one another, having to do with inventory. So the first we're going to do is inventory turnover ratio, which is basically what? Cost of goods sold divided by average inventory. And we can do the math. So we take 220 divided plus 185 divided by 2. Okay, that's the denominator. And we divide it into 900,000. And we're going to get a figure here of 4.44, right? 900,000 cost of goods sold in the numerator. And just kind of go back to the template that shows what these formulas are. 900,000 in the numerator divided by average inventory, which is, and we're going to assume a pretty basic calculation of beginning plus ending divided by 2. So you're getting 4.44. We take that, and now this number becomes the denominator, is what days on hand, or average days in inventory, whatever you want to call it, divided by 365, we have 82.21. Now, what does that mean? It means for this particular company, average inventory sits on the shelf for 82 days. And the question is that high? Is that low? Is that good? Is it bad? Well, we don't know. I mean, it depends upon the industry. If you're selling high-end artwork and sculptures, that may be pretty low, right? Those things don't really move, I mean, every day. Not that I'm an expert at all. Classic cars and whatnot, expensive cars. But if it's something like shampoo or things like lettuce and milk, that would be a very bad number. So it really depends upon the specific good itself, whether or not that makes sense. And that's what financial analysts are really tasked to do here, is to understand whether that's good or bad, based on the context in which we're dealing. In this case, it's pet supplies. I don't know what those are, but nonetheless, 82 days are what we're looking at there. Okay. All right. Just going to wrap this up here a bit. Home Depot, this is an example. And I assume these numbers are correct. And they do quarterly reporting, as all public companies do, right? They report what we call 10Qs to the government. They're publicly available information. And so we have these kind of things broken down. We have net sales, gross profit, and by the way, this is a very abbreviated income statement here, but we're sort of considering $22 billion in sales for the first quarter of 2017 and whatnot. So, and these are the numbers that are used by financial analysts to understand and analyze what's happening with a particular company. And we're assuming the numbers are correct. And why do we assume the numbers are correct? Well, hopefully we have ensured that auditing principles are once again being adhered to. And we had a bit of a blip, maybe not a blip, or a hiccup or a heart attack in the early 2000s with some of the companies that were just really creating fictional financial statements. And it's really on the onus is on the accounting industry to make sure that these are not there. So all these interim reports are the periods less than a year. So on a quarterly basis, that's pretty much what public companies are required to do. Sometimes they don't quite get it done in time, and that's a problem. They report non-GAAP earnings, but nonetheless, that's the expectation the government has for public companies. And one other thing, and this is something that's a bit beyond here, is that some companies do not want to be public companies because they don't want to meet these requirements. They don't want to adhere to GAAP. They don't want to report quarterly. They don't want all this information to be public. And so there's been something of a movement toward companies becoming not public companies. They take it private. And I think a lot of people believe that that's not a good thing, not a good event, but it is sort of the reality. So the reality is, if you want to issue shares to the public with a stock or debt, you've got to adhere to the requirements the government has, and you've got to have these disclosures, and the accountants are there to make sure the disclosures are right. But if you don't want that, then you are going to lose access to the capital markets, but it may be in your best interest to do so. So it's really not a clear-cut situation whatsoever. Okay. All right. So interim reporting, and we talked a bit about this before, and I've given some examples I think I talked about Apple and maybe Procter & Gamble, I think, in this course, where we pulled up some examples of the interim statements, what we call 10Qs. On a quarterly basis, companies, public companies, which is really the focus of this and pretty much all accounting courses, college accounting courses talk about public companies. They've got to report to the government what their results are, balance sheet, income statement, statement of cash flows, statement of retained earnings, and all the extensive notes that a company does, because sometimes to understand what's really going on, you're going to delve into the notes. And I know this is something that for the average person is problematic, and I get it. I really, really do, because think about this. I take an asthma medication. I get an inhaler. It's got all these notes and fine print, and I have no idea what I'm looking at, and it's a problem, right? But I sort of assume that it's good for me. My doctor prescribed it for me individually, and so it's probably good. The problem is with financial statements, it's not directed to the individual directly. This is directed to the public, and you got to kind of understand what's going on. And I would argue that the average individual investors who are looking at financial statements are sometimes baffled, just simply because of the fact that some of the information doesn't make sense. And by the way, as somebody who's been doing this for a long time, sometimes I see things in financial statements that I don't understand, and I got to kind of delve into it, particularly when it comes to things like foreign currency and whatnot, which I think I can handle on my own, but sometimes there are some curveballs that are out there. So it's difficult, and this is a problem, and it's not something that's going to be resolved overnight, but we should recognize as accounting professionals, this is a problem. Or we are being overly esoteric in our discussions of what are the facts, the material facts behind the company's operations. All right. So interim reporting, revenues and expenses. So we're going to report this in the same period in which they're incurred, revenues and expenses both. There's much more in revenue recognition a bit later, as well as expense recognition. And we're going to report them when they're incurred. That's what accrual accounting is really based upon. And also we sometimes expenditures extend over longer time periods, and so we will extend that in GAAP accounting. That's not so much the case with international standards. We'll talk about it in a second. Income tax expense should also be based on estimates as the effective rate for the whole year. So what's interesting, I'm a tax person, so is on a quarterly basis, companies should be estimating what their taxes are. And by the way, not only do they need to estimate it, they need to pay it on a quarterly basis, because the government wants its money at least once a quarter. And so as a result, corporations, which again our focus here, have to not only estimate it, but also pay it. And if they're off, well, it's not a huge crisis. I mean, I think a lot of people think of the IRS as being this, this really difficult agency. They're not really. If you're off a little bit, well, you make it up and you kind of deal with it. And so it's not that big of a deal. But the idea is compliance is important, and compliance is an important issue everywhere across the accounting field, whether you're in tax, audit, financial reporting, cost accounting, whatever. Okay. The unusual items are things like discontinued operations. Now, by the way, the discontinued operations, I think it was last week, we could not record everything. We had a sort of a technical glitch. And again, I felt really bad, and I actually felt kind of stupid that we're having these difficulties, but I re-recorded that, so it's posted in the Brightspace site when we talk a bit about discontinued items. So I think I've covered all the topics in this particular area, but make sure you look at that. So what are unusual items, things which are discontinued, and we have to sort of separate that. When do we separate it? When we know that they should be separated. That's usually we sort of wall it off and create a separate entity for that until that activity, whatever it is now done and gone, right? And I talked about the idea that sometimes companies will have divisions or even separate corporations that do certain things, and we decide we no longer want to do this. And so when we decide a discontinued operations, a discontinued operation, we sort of wall that off until we bring that thing to a close. Okay. All right, and let me see here. We have about 10 minutes, 11 minutes left, so we're in good shape on time. Let's talk a bit about this idea of earnings per share. So earnings per share, you can do it however you like. You can take out preferred dividends in the numerator. Usually it's net income minus preferred dividends over net income. And then you can divide that by common shares outstanding. Preferred shares are kind of a weird thing. We definitely got into this in 2010 when we said preferred shares are they're almost more like debt than equity, but they kind of got an advantage to the owner of the shareholder in the sense that the dividends are taxed at a lower tax rate. They have typically no voting rights. They may have a conversion privilege back to common stock, but not all cases have this. But nonetheless, the earnings per share is however you want to do it. And one of the things that I have been sort of harping on here is the idea that companies can or analysts can choose whatever method they want to do in order to slice and dice the reporting, and they can throw out certain things. I know when I was a young credit analyst, sometimes when a company's dealing with LIFO, we would convert it to FIFO because it didn't make sense. The LIFO system is an accounting. What's the word that is going to be politically correct? It's kind of a myth, really. Not many companies deal with a LIFO system, and so we would convert LIFO back to FIFO, right? On inventory accounting, because we didn't buy the idea that LIFO is a real thing, and frankly, it's pretty much not. And LIFO is not my favorite thing. I will teach it. I've done it for a long time, but you kind of get the idea. So in this regard, what we're talking about here with earnings is the idea we're putting earnings per share based upon all the same procedures and also any kind of changes that are going on. Now, remember, we talked earlier about the fact that what are the sorts of changes that might be disclosed to users, things like changing accounting principle, which is where we're doing something like, I'm talking about the company here, not the user. The company may say, okay, we're going to convert from FIFO to average cost or whatever, right? That would be a change in accounting principle. Or we're going to go from straight line depreciation on fixed assets to declining balance, right? Those are statement of principles, change in principles. But what about things like estimates where we're saying, okay, we thought our bad debt expense was going to be this, a percentage of receivables, it's going to be higher, it's going to be lower, whatever. Those are examples of estimates, right? So these are accounting changes, right? And we need to disclose how they're going to affect income from continuing operations. Now, one of the themes of Chapter 4 is this idea of continuing versus discontinued operations. Continuing operations are those where management expects are going to continue indefinitely, right? Which is probably the vast majority of operations. They're going to continue indefinitely, but some are not. And we're going to shut those down, which means we have to wall those off and report those a bit differently, right? So, but nonetheless, how does it affect income and also net income, which is really sort of the bottom line, and then any kind of per share amounts, which again, earnings per share is useful only to the extent that you have all the information as to share price and all that, right? Okay, so we're talking about minimum disclosures. These are the things that really need to be reported here. Things like sales, taxes, net income. Obviously, you can kind of read this for yourself. But what I really want to do is compare this, the GAAP accounting, to the international standards. And this is something that, for those of you who are going to be accounting students or accountants for a public company in the future, this is something that is going to be really applicable, I think, going forward. I really think it's some of the biggest issues in accounting right now. And we've got a lot of burning issues in accounting right now. We've got environmental issues and governance issues and currencies and tariffs and whatnot. So there are a lot of things going on. These are things that are not going to stop, and that's the reconciliation between GAAP and IFRS. And there are not a lot of differences here. In terms of interim reporting, these are quarterly statements. We're accrued and deferred, and we're in charge of the periods they benefit. Here, we're going to say the policies apply, and we're going to put it in the annual statement. So in the IFRS statements, we're not necessarily going to spread this out and allocate this on a quarterly basis. Okay, that may not be a big deal to a lot of people, right? I don't think this is a huge difference. Frankly, it's more of a policy difference. Interim periods less volatile under IFRS, and it's going to be more volatile. Why is it more volatile? Because you're not allocating these things. So expenses in particular, you're going to expense over longer time periods. You're not going to do it in the international standards, so you're going to have a little bit more volatility there. Income taxes are accounted for based on estimate in the as in an interim basis, right? Interim, and the same goes as international with US GAAP. Governments, yeah, funny thing, they want to receive their tax revenue on a routine basis, and that's kind of what they're up to. So in this regard, we have to kind of go along with that. So, all right, we've got about 5 minutes. I do want to talk a bit about the exam itself. If you have questions, feel free to get with me. But this is an exam, so this is not done in Connect, unlike your quizzes and homework. This is just a spreadsheet. It's been uploaded to the Brightspace site. Some have already done it. You've got until Sunday, 11 p.m. to do it. And so what's going on here? There are a lot of discussions. First of all, there's an academic honesty statement where you want to type your name, saying that you're going to do it on your own. You're not going to use professionals to do this. And this is something that, as we get further and deeper into the accounting profession, we require people to say that I'm doing this on my own. And it's your professional reputation on the line as far as that goes. And so, all right, so that's the first piece. Let's go and some of these are more easily done than the others. And let's talk about the first question here, which is maybe one of the more challenging ones, is frankly a bunch of journal entries. We've got a bunch of activities here, and they're listed A through H. And so what you're going to want to do is plug those in here in the journals. Remember, debits and credits. Debits on the left, credits on the right, and that's all you're going to do is simply post what the activity is and go from there. And I will review these to make sure these are correct. It's a manual process since it's done in Excel, and there's no other way for me to grade them but otherwise. And so just simply grade them, whatever it is, debits, credits. Keeping in mind that some transactions do not involve just one debit, one credit. Maybe it's one debit, two credits, or 3 credits and one debit, whatever the case might be. But you want to make sure that you're making sure that the transaction balances. Every entry in the accounting system should balance. If it doesn't, then the logic of the system breaks down, and you got to kind of go find it. That's why trial balances are important. They're way easier now than what they used to be because we can use technology to do it. But we are big believers here in finding out why these balances might not work. All right, so number 2 is we're simply taking these figures on the left and converting them to, or matching it's a matching question, basically. A and B, one of those. So full disclosure, which of these makes sense? Just simply plug it in, just simply enter it into the Excel spreadsheet. Save your work, save as you go along, but that's all you're really doing. Periodicity, what is that, right? All you're doing is sort of matching it. It's a matching problem, and we've all seen matching problems before, and that's what you're really doing there. Question 3, and I'm almost out of time, so I'm going to move a little bit quickly here, is you got a list of balance sheet categories, current assets, whatnot, and these are categories. These are not individual accounts. These are sort of subtotal accounts, and you're going to sort of match up where these individual accounts are and where we would sort of fit these, right? Notes receivable, what is that? Is it a current liability? Like, yes. If it's due 2028, that would be a long-term liability, right? So you got to kind of think about what's going on there. And that is one of the shorter ones, frankly. And use your text. You can use any resource available. We just ask and require that you do not work with others and do not bring in CPAs. I know most of my friends are CPAs, and I do not call them and have them help you with exams. So that's not what we want to see happening. Number 4, following is post-closing trial balance. And so what are you being asked to do here? You're going to end up with discussing what are these values. And so some of this is mostly self-explanatory. I really, don't think I need to go all through this, but let's just simply answer what's being asked for. In this case, it's a balance sheet, okay? And where the balance sheet is boom, right here, right? Next tab over. And you're gonna do, it's blank because you're gonna do it, right? And we're not looking for perfection here. It's not, it's not. But the balance sheet should balance, and I hate to say that, but it really should balance, and so that's something we're looking for there. And the final question deals with 2 different scenarios where you've got a company that's got a business, and you're going to sort of deal with 2 different scenarios. You're going to do scenario 1 and scenario 2, right? And so you're going to want to do both of these, enter these in the spreadsheet, which is the next tab over, and talk about what the effects are going to be on these particular scenarios. And by the way, this is a very, very, very common setup in accounting where we are faced with one scenario and another scenario. And these are blank because it's up to you to do with what you want to do with them. And Excel skills are really important. Maybe you like or don't like Excel, but it sort of is the default standard for a lot of what we do in accounting and finance. And so you want to kind of use that and go from there. And the most important thing is if you have questions, get with me. I'm here all weekend. And certainly tomorrow, I'll be out in the morning tomorrow, but I'll be back. Email is a great way to reach me. It's the best way. And if you want to have me call you, give me a number. I'll call you back. We'll walk through it. We'll do a Zoom call if you want, and we do a share screen. I'm more than glad to do that. And I'm here to help, and I really do want to help you do this. And so remember, you have chapter 4, homework and quiz due this Sunday, as well as this exam as well. Now, the great thing about the exam, it's not timed, and there's no end. It's a spreadsheet you can download, and when you're happy with it, just upload it, and we'll go from there. And I'll review it, and we'll kind of go from there. So again, if you have questions, feel free to reach out to me. And if I don't hear from you, have a great rest of your week, and I'll see you next time.